Last month, a Chinese AI company listed on the Hong Kong Stock Exchange hit a market cap of 100 billion US dollars. Its annual revenue, 100 million. That's a price to sales ratio of 1,000 to 1, and it's not even the most overvalued one on the exchange. Hong Kong was once the undisputed king of IPOs. For years, companies from around the world flocked to list there. It raised more capital than London, more than Tokyo, more than anywhere except New York. Today, Hong Kong has fallen to third place, ousted by American exchanges turbocharged by mega IPOs like SpaceX, and then surpassed again by mainland Chinese markets in Shanghai and Shenzhen. But Hong Kong is fighting back with AI. Over the past 18 months, the exchange has welcomed a wave of new listings from Chinese artificial intelligence companies. Large language models, autonomous driving firms, chip designers, semiconductor foundries. The marketing pitch is irresistible. These are China's answers to OpenAI, to Nvidia, to Tesla. They are building the Chinese tech stack that will replace American dominance, and investors have been pouring in. Some of these companies have achieved extraordinary valuations within weeks of listing. But here's the question that matters. Are these valuations real? Or is Hong Kong's new IPO boom a disaster waiting to happen? Today, we are going to examine four categories of AI stocks that have listed in Hong Kong. We're going to look at the actual numbers, revenue, earnings, market caps, and stock performance. And we're going to give you a framework for deciding whether any of these companies deserve your money. Let's start with the largest category and perhaps the most hyped, the Chinese large language model companies. In January 2026, a company called Zhipu AI listed on the Hong Kong Stock Exchange under ticker 02513. Within weeks, its share price surged from around 1,588 Hong Kong dollars to over 2,500. The market capitalization crossed 800 billion Hong Kong dollars, over 100 billion US dollars, for a company that had never turned a profit. Zhipu AI calls itself the Chinese Open AI. It builds foundation models for Chinese language tasks, and it does have real technology. The question is whether that technology translates into real revenue. The numbers tell a stark story. Annual revenue is around 724 million RMB, roughly 100 million US dollars, against a market cap of over 100 billion US dollars. That is a price to sales ratio of approximately 100 to 1. To put that in perspective, when Nvidia traded at 100 times sales, it was growing revenue at over 50% per quarter. Zhipu's revenue growth, while positive, has been nowhere near that pace. The company is also unprofitable, meaning it burns cash every quarter. This is not uncommon for early-stage AI companies. Amazon traded at extreme multiples for years, so did Tesla, but those companies eventually produced enormous profits. The question is whether Zhipu ever will, and that raises an uncomfortable reality about China's LLM market. Unlike the United States, where three models dominate, OpenAI's GPT, Anthropic's Claude, and Google's Gemini, China has dozens of large language models. DeepSeek offers its model for free. ByteDance pushes Doubao through its ecosystem. Alibaba steers its cloud customers toward Qwen, and Zhipu is fighting for scraps. Distribution is everything in AI. OpenAI has consumer habit. 1 billion people use ChatGPT weekly. Anthropic has enterprise relationships. Companies build custom applications on Claude. Google has Android, Workspace, and decades of user data. Zhipu AI has none of these advantages. It has a good product, it has government contracts, and it has a $100 billion valuation, but it lacks the ecosystem lock-in that makes American AI companies so profitable. The same valuation problem shows up in Category 2, AI chip design. China has been trying to build a domestic semiconductor industry for years. The goal is to replace American chips, especially GPUs, with homegrown alternatives. Several of these companies have listed on Hong Kong or Shanghai markets in recent months, and the numbers are stunning. Take Cambricon, ticker 688256 on the Shanghai Star Market. At its peak, the company's market cap reached 1.4 trillion yuan, roughly 200 billion US dollars. Revenue runs about 20 billion yuan per year. That's a price to sales ratio of 70. At that valuation, you're paying Nvidia prices for a company with a fraction of Nvidia's profits. Nvidia's data center GPUs are the industry standard. Cambricon's products are not. They compete on price, not performance. And many of these chip companies face a structural problem. They are sanctioned by the United States. American export controls bar them from accessing advanced chip manufacturing. Extreme ultraviolet lithography, the technology needed to print the smallest transistors, is off limits. High bandwidth memory chips, called HBM, cannot be sold to Chinese companies at all. Chinese firms have stockpiled older HBM2 memory. They have designed chips using older process nodes. They have made remarkable engineering compromises, but the gap is real. A Chinese AI chip costs roughly the same as an American one, but delivers 1/500th the performance for training large models. And even if you design the best AI chip in the world in China, you still need someone to manufacture it. Only two companies on Earth can fabricate chips at 3 or 4 nanometer scale: TSMC in Taiwan and Samsung in Korea. Both are restricted from taking Chinese orders under American rules. Huawei is building domestic capacity, but the technology lags years behind. This is not a minor inconvenience. It means every Chinese AI company is running uphill, paying Silicon Valley prices for inferior hardware. Category 3: Autonomous driving. If any sector should be booming right now, it is this one. Electric vehicles are mainstream. Autonomous driving technology is advancing rapidly, and China is the world's largest car market. Yet several autonomous driving companies listed in Hong Kong have seen their share prices collapse. Black Sesame Technologies, ticker 02533, makes AI chips for self-driving cars. The company went public to great fanfare, but the stock has cratered. From its highs, it lost over 90% of its value. By mid-2026, PitchBook valued the shares at around 1.45 US dollars. The company is viable, the technology works, but the revenue never materialized fast enough to justify the IPO valuation. Other autonomous driving stocks have followed similar trajectories. One listed at 43 and is now at 23. Another debuted at $29 and crashed to 3, a 90% decline. The market that was supposed to be China's crown jewel has become a graveyard for early investors, and there is a good reason for this. Autonomous driving is genuinely one of the hardest engineering problems humanity has ever attempted. It has been hard for American companies with unlimited computing power and billions in funding. For Chinese companies facing chip shortages and limited training data, it is even harder. Tesla's full self-driving system relies on over 20,000 GPUs running in parallel to train its models, plus over 100 billion miles of real-world driving data. Waymo has been refining its technology for more than 10 years and still operates in limited geographies. Two major American autonomous driving efforts, GM's Cruise and Intel's Mobileye, have been suspended or severely curtailed. In China, none of these companies have Tesla's data, none have Waymo's patience in development, and most rely on Nvidia chips they cannot easily obtain. The paradox is painful. These companies should be booming. The technology is real, the market is enormous, but building a real autonomous driving business takes a decade and tens of billions of dollars. The IPO valuations assumed the rewards would come in years, not decades. The fourth category is perhaps the most sobering: semiconductor foundries. China has spent years and billions of dollars subsidizing domestic chip manufacturing. Dozens of new fabrication plants are under construction. Most are focused on mature processes, 28 nanometer and above, rather than the cutting-edge nodes that power AI. And that is the problem. Anyone can build a 28 nanometer factory. There is no secret sauce. There is no durable advantage. When dozens of competitors enter the same market with government subsidies, the inevitable result is a price war. Margins collapse, profitability becomes impossible. Some of these foundries have managed to list on public markets, raising capital from investors who see semiconductors and think high technology. But mature node semiconductor manufacturing is a commodity business. It is as lucrative as making generic plastic goods, barely. So here we have the full picture of Hong Kong's AI IPO boom. Valuations built on American-level expectations with Chinese-level revenues. Technology that is genuinely improving, but never quite as good as the American alternative. Manufacturing that cannot access the tools it needs, and a foundry industry that has turned a strategic necessity into a financial disaster. Does this mean every Hong Kong AI stock is worthless? Absolutely not. DeepSeek has produced world-class models at a fraction of American costs. Huawei's Ascend chips are improving rapidly. Some Chinese electric vehicle companies are among the best on the planet. There is real innovation happening in China. But innovation is not the same as investment returns. The two are only loosely correlated, especially when the innovation is already priced in at American valuations. So before you buy any Hong Kong AI stock, I want you to ask 4 questions. First, how much actual revenue does this company have? Not projected revenue, not total addressable market, actual current revenue. Second, what are the losses? Most of these companies are unprofitable. That can be acceptable if the losses are narrowing. But if losses are widening as a percentage of revenue, the company is moving in the wrong direction. Third, does the company have a distribution advantage? Does it own a customer relationship that competitors cannot easily replicate? OpenAI has consumer habit. Anthropic has enterprise contracts. Nvidia has CUDA, a software ecosystem that locks in developers. Without a distribution advantage, even great technology becomes a commodity. And fourth, is there a trap? Is the company locked out of critical technology by sanctions? Is it competing with government-subsidized rivals who do not need to make a profit? Is the valuation already pricing in 5 years of perfect execution? Most Hong Kong AI stocks fail at least 2 of these tests. Many fail 3. A few fail all 4. None of this means you should never invest in Chinese AI companies. It means you should invest with clear eyes. Understand what you're buying, know the constraints, and never, ever pay Silicon Valley prices for Chinese commodity businesses. The real investment opportunity in Chinese AI is not the obvious one. It is not the company claiming to be the next OpenAI. It is the company with real revenue, genuine market share, and a valuation that reflects its actual risks rather than its ambition. Find those companies. They exist, but you will need to look past the hype, past the marketing, past the flag waving and the national pride. You will need to read the actual financial statements, and you will need the discipline to walk away from 95% of what's on offer, because in Hong Kong's current AI IPO market, the companies worth owning are the exception, not the rule.